You've probably heard you can earn $300 a fortnight without touching your age pension. That part is true. But there are three separate situations where that $300 buffer quietly disappears, and most retirees don't find out until a payment lands lower than expected. I've watched this happen to people who did everything right on paper. They kept their earnings under the limit. They still came up short. The problem wasn't the $300 rule itself. It was what sits underneath it in how Centrelink actually counts the money. By the end of this video, you'll know how the work bonus really works, what changed with the age pension rates and thresholds from the 1st of July 2026, and where the deeming rules quietly reduce what you keep, even if you never earn a cent yourself. For some households, understanding this properly is worth thousands of dollars a year. That's not nothing at 63 or 64, with retirement close enough to touch. None of this happens because someone did something wrong. The rules are just more layered than the headline number suggests. And nobody sends you a memo explaining the exceptions. Most people find out when a payment lands short, not before. There's also a second layer to this. Even people who never plan to earn another dollar in retirement are affected by what changed this year because the assets and income thresholds moved for everyone, working or not. We'll get to that in a moment. If you're the kind of person who wants to keep working a little, on your own terms, without losing ground on your pension, stick with me. Subscribe if this is useful, because we're about to get into exactly where that $300 buffer breaks down, starting with the trap that catches the most people first. Here's the mechanism first, then the traps. The work bonus lets you earn up to $300 a fortnight from work without it touching your pension. Any part of that $300 you don't use rolls over, and it can build up to a maximum bank of $11,800. On top of that, when you first put in your age pension claim, Centrelink automatically credits your work bonus bank with an extra $4,000, so you're not starting from zero. That sounds generous, and it is. But there are three places where people assume the work bonus is protecting them when it actually isn't, and it rarely works the way the headline number suggests. The first is self-employment. If you're a sole trader, like a lot of retirees who pick up handyman work, tutoring, or bookkeeping on the side, Centrelink doesn't look at what actually lands in your account each fortnight. It works off an annual estimate, built from a profit and loss statement you provide up front, then checked again at 13 weeks, 6 months, 9 months, and the 1-year mark. Your income gets smoothed evenly across that whole period, whether or not the work actually arrives that way. So if you have a good spring and summer doing outdoor jobs, then almost nothing over winter. Centrelink still assumes a flat income the whole year through. If your early estimate turns out too low once the real numbers come in, you can end up with an overpayment to repay later, not because you broke a rule, but because the smoothing didn't match how your business actually works. The second is about how you're set up. A lot of people assume that once their income runs through a company, a trust, or a partnership instead of their own name, the work bonus stops applying. That's backwards. What actually matters to Centrelink is whether you are the one doing the work. Active participation is the test, not the legal structure sitting around it. Where the work bonus genuinely does not apply is passive income, managing an investment property or a family trust that just holds assets without you doing any actual work for it. So the trap isn't losing the work bonus because you used a company structure. It's assuming a business structure automatically protects income that was always going to be treated as investment income anyway. The third is that $4,000 opening credit. It's real and it's useful, but it only happens once, at the moment you first claim the pension. It isn't something that tops up again later, and it isn't tied to when you start working. The people who miss out are usually the ones who've already been on the pension for a year or two before they properly understand how the work bonus works. By the time they learn about it, that early cushion has often already been used up on ordinary income. Or it was sitting there unused the whole time because nobody told them it existed. None of this makes you careless for not knowing it. Almost nobody explains it this clearly. And the official pages read like they were written for someone who already understands the system. But it does mean the $300 headline number is only the surface of it. Now you might be thinking, none of this applies to you because you're not planning to work in retirement at all. Fair enough. But the changes from the 1st of July 2026 affect your pension whether you earn a dollar or not. Let's look at what actually moved. Meet Mark and Sue for a minute, because their numbers make this easier to follow than me reciting figures at you. Mark is 63, still doing handyman work a couple of days a week as a sole trader. Sue is 61 and stepped back from full-time work last year. They own their home outright. They've got $400,000 between them in super and $50,000 in savings sitting in a bank account. They're planning to wind back work over the next couple of years, well before either of them reaches pension age at 67. That gap between stopping work and actually becoming eligible is exactly why these numbers matter now, not later. Get your assets and income sorted while you've still got time to adjust. And Centrelink's rules stop feeling like a surprise the day you finally apply. From the 1st of July 2026, the numbers that decide whether a couple like Mark and Sue eventually get a full pension, a part pension, or nothing at all moved higher. For a homeowner couple, the assets test lower threshold sits at $499,000. Stay under that with your assessable assets, and assuming you also meet the income test, you get the full pension. Go above it, and the pension steps down gradually until it cuts out completely at $1,102,500 for a homeowner couple. Here's where it gets interesting for Mark and Sue specifically. Their super sits in accumulation phase, and neither of them has reached pension age yet. Money in accumulation phase before pension age isn't counted in the assets test at all. So right now, their assessable assets are really just that $50,000 in savings, nowhere near the $499,000 line. Once they do reach pension age, though, that $400,000 in super comes into the picture, whether it's still sitting in accumulation or has been converted into an income stream. That's the moment the real assets test math actually starts for them, not today. To see why that matters, imagine their combined assessable assets end up around $600,000 by the time they're both eligible, once super counts. That's roughly $100,000 over the $499,000 threshold. At about $3 a fortnight lost for every $1,000 over, that trims close to $7,900 a year off their pension. That's not an abstract number. That's the difference between comfortably covering the council rates and the car registration each year, and having to dip into savings to cover the gap. The full pension rate itself is $1,200.90 a fortnight for a single person, or $905.20 each for a couple. So that's the ceiling they'll eventually be working toward. Assets are only half of it, though. The income test looks at what's actually coming in, and it's assessed completely separately from what you own. For a couple, combined income can sit at $396 a fortnight before the pension starts reducing, and it phases out completely once combined income passes $4,016.80 a fortnight. This is where Mark's handyman income actually matters once he's pension age and claiming. If his sole trader earnings, smoothed the way we just talked about, push their combined assessable income past that $396 figure, they start losing pension on top of whatever the work bonus is already shielding. Here's the trade-off most people don't see coming. You can pass the assets test with room to spare and still take a real hit through the income test, purely because you like staying a little busy. That's not a planning failure. It's just how two separate tests interact, and almost nobody explains that they're judged on separate rulers, not folded into one number. There's one more twist that catches people out, even when both their assets and their actual income look fine on paper. Centrelink has a separate way of deciding how much you should be earning from your savings and investments, regardless of what your bank statement actually says. That's called deeming, and it's where a lot of future retirees lose pension they never expected to lose. None of this means Mark and Sue, or anyone in their position, should feel behind. Most people learn these rules the hard way, after a payment changes, not before. Working through it now, while there's still time to adjust the numbers, is exactly what puts you ahead of where most retirees are when they first apply. Deeming sounds complicated, but the idea underneath it is simple, even if the result feels unfair sometimes. Centrelink doesn't ask what your savings and investments actually earned this year. Instead, they assume a set rate of return, no matter what your bank statement says, and count that assumed amount as income. From the 1st of July 2026, the lower deeming rate is 1.25%, and it applies up to $66,800 in financial assets for a single person, or $110,600 for a couple. Anything above that is deemed at the higher rate of 3.25%. It doesn't matter if your money is sitting in a savings account, earning almost nothing, or locked into a term deposit from a couple of years ago at a rate that hasn't kept up. Centrelink counts the deemed amount either way. Say Mark and Sue's $50,000 in savings is only actually earning them around $250 a year in real interest, because it's sitting in an account that hasn't kept pace with better rates elsewhere. Centrelink doesn't look at that $250. Under the 1.25% deeming rate, they assume the same $50,000 is earning $625 a year. That's $375 more than the money is really making them. If that gap tips their combined income over the free area, it costs them real pension for income that only exists on Centrelink's ledger, not in their actual bank account. I used to think deeming was a fair enough shortcut. Centrelink can't check every bank statement every fortnight, so a flat assumed rate seemed reasonable enough on the surface. Then I watched someone in almost the same position as Sue get her pension trimmed, because her term deposit was locked in at just over 1%, while Centrelink assumed she was earning more than 3 times that on part of it. She hadn't done anything wrong. She'd simply locked in a safe, low rate at exactly the wrong time, and had no idea deeming was working against her until her payment came in lower than usual. That's the part that catches people off guard. It's not laziness, and it's not bad luck exactly. It's that most people assume Centrelink is measuring what actually happened in their bank account, when really it's measuring what Centrelink thinks should have happened. The gap between those two numbers is where pension quietly disappears, month after month, without a single letter explaining why. It's worth saying plainly, this isn't something you can argue your way out of with better paperwork. Deeming applies the same way whether your money sits in a bank account, a term deposit, or shares. The only real lever you have is understanding where the thresholds sit and where your own money falls against them. So you've seen where the work bonus breaks down and where deeming can count money you never actually earned. None of this is complicated once you can see the mechanism underneath it. Let's put it together into 3 specific things you can actually do about it. The first thing worth doing, whether you're already claiming or planning ahead, is to check your work bonus balance directly through your Centrelink online account in MyGov, rather than assuming it's sitting at the full $11,800. If you're self-employed, keep your profit and loss estimate genuinely up to date, especially around the 13-week review point since that's the moment an inaccurate early estimate turns into a real overpayment later. A 5-minute update now is a lot cheaper than a repayment notice in a year's time. The second is reviewing your asset mix before the next indexation date in September rather than after it. If your assessable assets are sitting close to a threshold, it's worth deciding deliberately whether to spend down some of it on something like home renovations or bringing forward maintenance you were going to do anyway, or to leave it where it is. Just be careful with gifting. Giving away more than $10,000 in a financial year or $30,000 over 5 years still counts as if you own it for 5 years afterward. Say Mark and Sue spend $30,000 on home renovations instead of gifting it. Their assessable assets drop by that amount. They still sit well under the relevant threshold, and they end up with a more comfortable home instead of a chunk of money sitting idle in a savings account. The third is understanding exactly when deeming starts applying to your money and when it doesn't. Superannuation sitting in accumulation phase, before you've reached pension age, isn't counted in the assets test and isn't deemed at all. Once you reach pension age, or once you convert that super into an income stream, both change and your balance comes into both tests. Knowing that timeline in advance means you can plan around it, instead of being surprised by it the day you actually apply. I had someone tell me once about a friend, self-employed, who didn't realize how the profit and loss review actually worked. He assumed as long as he stayed under $300 a fortnight, on average, he was safe. His income came in lumpy, heavy in the warmer months, thin in winter, and when the real figures were reconciled against his early estimate, he ended up owing back several months of overpaid pension. Nobody had explained the smoothing to him. That's the whole point of going through this properly now, rather than finding out the hard way later. If you want more of this, straightforward explanations of how these rules actually work, without the jargon, hit subscribe. New videos come out most weeks, and there's more coming on how these same rules interact with super drawdowns. So that's the full picture. The work bonus is genuinely useful, but it has real exceptions around self-employment smoothing, business structure, and that one-off opening credit. The changes from the 1st of July, 2026 lifted the assets and income thresholds, which may move you from missing out to qualifying for a part pension or the other way around. And deeming can quietly count income you never actually received. If this was useful, give it a like and drop a comment. I read them. If you know someone getting close to this stage, someone who's still working part-time, or wondering how their savings will actually be assessed, send this video their way. It might save them a lower payment down the track. Thanks for watching, and I'll see you in the next one.